So chapter 11 is saving and investing options. So today is low risk choices, tomorrow is medium risk, and then either Thursday or next week we'll look at high risk choices. So illiquid means it is not convertible to cash quickly or without penalty. So we talked about liquidity last chapter. That was one of your definitions, how quickly something can be turned into cash. So illiquid is not quickly. So a liquidity return trade-off is the more liquid the account, the lower the return. So your standard savings account that you can go to the bank, and I know some of you probably already have, um, they have a lower interest rate, but you can go in and get all of that money out at any time. Um, you get a higher return by giving up some of that liquidity. So, low risk saving options offered by commercial banks. So, your standard savings account. You can also do money market accounts. So, there's a money market deposit account, which is a bank account that's FDIC insured. So, remember, that means the government will back it up to $250,000. And a money market fund is not a bank account, but it's invested in low risk securities like the US Treasury bills. So it's not FDIC insured. It's still considered a low risk option because the money is invested in the government, which are the same people that back the FDIC. And so these are similar to savings accounts, except you typically have to put larger deposits to kind of get started with them. And then also with money market accounts, you typically are going to be limited to how many times you can withdraw money each month. That may be penalized if you go over, and they often have to have a minimum balance in them. And some savings accounts are similar too. So another low risk saving option is a certificate of deposit. We're not going to watch that video here, but they're called CDs. So they pay a higher rate of interest than savings or money market accounts, but they're not as liquid and they're subject to withdrawal penalties. The maturity date, this is the definition from your book, is the date on which an investment becomes due for payment. So CD terms usually range from a few months to 5 years. So again, you would pick that term when you set it up. But they also have a early withdrawal penalty, which is a fee imposed to discourage depositors from withdrawing the money before the stated time period. So the way this certificate of deposit works is you put money in and it's locked in again for a few months to 5 years. It could be longer, but it's locked in. You know what rate you're getting. You'll know how much money you're getting back at the end if you don't take any money out. But if you take money out early, then you're going to have to pay. So that's what we were talking about last chapter, the importance of making sure it's money you don't need. So when you have your 6 months worth of savings and then you want to kind of start putting money away that's illiquid, you could start with this low risk option of saving that's just illiquid. You can't get it very quickly without giving them some of your money. And then there are jumbo CDs which pay higher interest rates. But those are typically if you have $100,000 or more to deposit into them. So this is an example of an early withdrawal penalty. So kind of looking here, they deposited $5,000 and then the interest rate is 5% every year and the term is 5 years. So the penalty, it says if the money is withdrawn before 5 years, the penalty imposed will equal 365 days interest, whether earned or not. So no matter how early you take this out, there's no stipulation on when, on this particular example, you're paying interest for 1 year, how much money you would have earned. So this scenario is you withdraw money after 180 days. So remember, interest is principal times rate times time. So the principal is $5,000 times the rate is 0.5%, 0.05 or 5%. And then the time, it's in the account for 180 days out of 365 days in the year. So you would be earning $123.29 interest just by putting your money in this account. But by taking it out early, your penalty is $250. So you put $5,000 in, you got $123 in interest, but then you pay a penalty of $250. So you're only going to get $4,873 back. So you need this, in this example, if you need the money in 6 months and not the 5 years that you agreed upon, you're actually going to lose money. So you want to make sure that it's money that you can really have locked away. There's also life insurance companies. So they permanent life insurance accumulate savings called its cash value. So if you cancel your policy, that's the money you would get. There are no penalties for withdrawing early, but it's not a bank account, so it's not insured. I wouldn't this is my own personal opinion. I wouldn't consider a life insurance plan a great savings option. Typically, if you have life insurance, it is to leave money for your loved ones or someone that will need it when you are no longer around. Yes, if you need the money, you can cash it out early, but then it leaves the people you were leaving money to without that option. But this is for permanent life insurance, not term life insurance. So term life insurance, just so you know what it is, it's for a set term. Those don't have cash values. Term life insurance plans are 10 years, 15 years, 20 years, 30 years. It's a set number of years. And if you live longer than that term, then that life insurance policy is just gone. Different people have different opinions on those. They are cheaper, but that's not what we're talking about now. So I'm not going to get into that too much. But you can get cash value from your life insurance policy. There's also a brokerage account. So it's an account opened with a brokerage firm. It may pay interest, be used like a checking account, and be used to buy investments. It is not FDIC insured. So it takes money and they buy and sell investments for you. So when they sell investments, they put money back into the account and so forth. Your earnings on interest are typically low, but they're typically higher than your standard savings account. If you work with a reputable investment company, then it's considered a low risk choice. All right, and then low risk investing options. So investments are going to vary in the term, the risk, the rate of return, and the liquidity. So typically, I know we said this at the end of last chapter, you want to start your investments with safer options to have that solid foundation. So bonds are considered a safer option. A bond is a loan that the buyer makes to the bond issuer at a fixed interest rate, which is why they're called fixed income securities. Sorry. So bonds are sold at face value, which is the amount the bondholder will be repaid at the maturity date. So depending on the length of the bond, maybe it's 3 years. If the face value is $5,000, you're going to get $5,000 in 3 years. You can buy bonds from the government or from companies. So corporate bonds, nope. So I thought we were going there next. Sorry. How to make money on bonds. So you can sell bonds before your maturity date for a price higher than you paid for it. So again, if the term is 5 years, you might be able to sell it in 3 years for more than you paid. If it's a premium bond, that's a bond that sells for more than the face value. So the bond's only $5,000. You might actually pay $5,200 for it. But if it has a good interest rate, then and you collect interest as it grows, then that's could still make you money. And then a discount bond is a bond that sells for less than the face value. So we'll look at that example in a minute. And then you can also earn interest on the bonds that you own. So the coupon rate is a fixed rate of interest that is paid semi-annually, so twice a year for the life of the corporate bond. So again, there's a lot here on the bonds, and I don't expect you to memorize all of this when you leave this class, unless bonds are something that really interests you. But just so that you have the background knowledge at least. So this example for a corporate bond return, so the face value is $5,000. The discount rate is 4%. So that's like it's on sale. The coupon rate is the 4% yearly paid semi-annually, and it's for 2 years. So the purchase price, you do $5,000 times the 4%. So it's a $200 discount. So you pay $4,800 to buy this bond. It also has a 4% coupon rate. Sorry, I might have said that before, not a discount rate. So you get $200 interest per year. So $100 once and then $100 again in a year. So you do that for 2 years. So you get $400 in interest. So you end up paying $4,800 for this bond, but at the end, you get $5,000 for the bond plus the $400 interest. So you end up making $5,400. Well, you end up getting back $5,400. So you make $600 because you invested $4,800. So your ROI is 12.5%. So there are different types of the corporate bonds. A callable bond is a bond with a clause that allows the issuer to repay the bond before the maturity date. So say you go to this company and you buy a bond and it's supposed to be for 5 years. They can choose to give you the money in 3 years. And then you wouldn't get as much interest, but that's something that could be written into the terms of the bond. A convertible bond is a bond that can be exchanged for shares of common stock at the option of the bondholder. So some people like this option, because this type of bond, because it gives them options. And you may get stock for less than kind of the market price. So, you know, this $1,000 bond, you might get 50 shares of stock at $20 each or something. And then a zero coupon bond is a type of corporate bond that's sold at a deep discount, but it does not provide interest payments and is redeemable for its face value at maturity. So these zero coupon bonds, maybe it's a $10,000 bond, but you only pay $4,000 for it. But in 5 years, you're going to get that $10,000 because that's the face value of it. And those are all taxable. But there are still risks with bonds. So there's the default risk. The company or government may not be able to pay you back. So if you get a bond maybe from a new startup company that you have faith in, if they don't do well, they could default and then you're not getting your money back. One way to avoid this is to look at the bond rating. You can go to websites such as Moody's, S&P, and Fitch, and they're going to rate bonds to tell you basically how safe they are. They give them a grade. I don't expect you to memorize those websites now. Just know that there's something out there for that. There's the interest rate risk. Since they pay fixed interest rates, if the market rates rise, your bond loses value. Inflation rate, same idea. If inflation rates rise, there's a risk that the real rate of return of your bond could go below zero. So it could go to zero or even negative. So in the blue there, it says if your bond is paying 3% interest and inflation is 2%, your real rate of interest is only 1%. And if inflation were 3%, then you would basically be getting zero in interest. And then municipal bonds are issued by governments, but not federal governments. They're more local governments. So the states, counties, cities, and towns. And they often pay for things like roads or buildings. The interest is usually lower than the corporate bond, but it's exempt from federal and state taxes. So some investors that are in a high income tax bracket, they may like this option because it doesn't, they're tax exempt here. There's also U.S. government savings bond. So it's basically a loan to the U.S. government, and they're generally considered safe. They have terms from 1 to 30 years. They have the different series. They have ones that are adjusted for inflation. They are subject to federal tax, but not state tax. So another option, there's also U.S. government treasury securities. So the government offers bonds and they offered the different types of treasury securities. So there's still another loan to the government. There's the treasury bills, the notes, the bonds, and the inflation protected securities. Your book has a different paragraph on each one of those. Again, if there's something that you think you might be interested in, they're safer, they have a little bit higher return rate than your savings account, then by all means, please look into those and know what one will fit your needs best. And then finally, the last thing here for the low risk investing options is an annuity, which we talked about annuities a long time ago when we were talking about taxes. But it's a contract in which you make a lump sum payment or a series of payments that earn interest. So you can put one lump sum in at the beginning, or, you know, every month you put in $1,000. And then in return, you receive regular disbursements, usually when you retire. So these are issued by life insurance companies. So they're not FDIC insured. So they're as safe as a life insurance company issuing them. So if you go to a well-known, reputable life insurance company, then this would be considered more of a safe option. If you go to a new startup company, probably not considered as safe because you don't know how they're going to do down the road when you reach retirement age. And so the tax on these is deferred until you start receiving them. And some of the annuities will be, you know, for the rest of your life. Some of them might be for 20 years. It's going to be how it's set up in your contract. So to recap, kind of before we go, today we were looking at low risk options. So we started talking about savings account, money market accounts, certificates of deposit. Then we talked about bonds. There are a lot of different types of bonds. There are still risks that go with them. You can get bonds from the government or from different companies. Just again, we didn't go very deep into any of those. Your book has more information. The internet has a ton of information. Look wisely if you look on the internet. Know if it's good source or not. But those are just your